here's a conundrum. What the heck are we supposed to do with the banks in this environment? 2016 was supposed to be the year of the financials. Federal Reserve on track to raise interest rates 4 more times, something that would instantly make every bank more profitable by boosting their net interest margins. What are we supposed to do here? But right now, despite recent protestations from the New York Fed President Bill Dudley that where all systems go for more rate hikes, I find it hard to believe that the Fed will actually follow through with its plan, given the massive collapse in commodity prices and the fact that the rest of the world, well, it seems to be slowing. So many industries in our country seem to beat. And if the Fed decides to put its tightening spree on hold, where does that leave the banks, and in particular, where are the regionals, which are down 15% year to date? Consider a very fine bank, First Horizon National, FHN, which has a large regional bank operation under the First Tennessee brand, more than 200 locations across the South, along with a wealth management business that's booming and some fixed income capital market offerings. First Horizon just reported on Tuesday morning the company delivered a 1-cent earnings miss off a 21-cent basis, higher than expected. Revenues, though, up 7% year over year. That's what I wanted. They had some nice loan growth, 5% increase in net interest income. But the bank's earnings did get hit by a one-time non-interest expense. So can First Horizon get much lift without more help from the Fed? Let's take a closer look at Brian Jordan, the chairman, president, and CEO of First Horizon National. Find out more about the quarter where his company's headed. Mr. Jordan, welcome back to Mad Money.
Thank you, Jim. Thanks for having me back.
All right, Brian, it's driving me crazy. You had a great quarter. You have loan growth. You have no charge-offs to speak of. You've got no bad loans. You're down in Texas, but you missed any of that oil problem. Why is your stock trading as if all that matters is what the Fed's going to do?
Yeah, I think, you've seen the whole industry trade off since the beginning of the year, and we've been largely in line. I'd have to say I'm a little bit of disappointment in the stock trading down on one hand. The other hand, as you note from our earnings call in the past couple of days, we've said we want to buy some stock back, so we look at it as an opportunity. The stock's on sale, we'll buy some. I fundamentally think that the economy continues to be pretty strong, that the overall recovery continues at the slow, modest pace we've had for the last several years. And so, given the strong loan growth, the strong credit quality, it is a little surprising that we traded off since the beginning of the year. But as I said, it's on sale. We'll buy a little bit back in our stock repurchase program.
Well, let's talk about the notion of top-line growth. Your bank has it. I mean, you basically do. There's a lot of big banks that absolutely don't. You're in a very robust region, and you're taking advantage of it. Is 2016 the year that instead of worrying every minute about what the Fed's going to do, we should start looking about growth banks versus value banks? Because I know I like growth.
Yeah, I think, well, let's start with the Fed. I think, as you've noted in your comments in the last several weeks, and some of the Fed presidents have stated, this 4 rate moves is not certain. It may be 4, it may be less, and it's going to be hopefully data dependent. We think against that backdrop where we would get some help, we can continue to do what we've done for the last several years, and as you noted in 2015, continue to grow loans, continue to grow customer relationships in a high-quality fashion. As I say, shooting at the heart of the market and winning those relationships and those customers that matter for the long term. And if we can do those things and continue to capitalize on our financial metrics and what we refer to as our bonefish targets, we'll continue to create significant value for our shareholders in what's likely to be a continued difficult operating environment.
Do you think that in some of your areas, you're in a lot of good areas that I would like to be a buyer of and be invested in, that real estate has gotten too hot? We are seeing that in some regions of the country. I know that Nashville's gotten too hot. Boston's gotten too hot. San Francisco, New York is insane. Are you experiencing any of that because how cheap money is?
No, to date, we're not seeing that. And we have a big presence in Nashville, and we continue to grow there. And even in Nashville, where you've seen the most appreciation in real estate in the state, it still is being supported by activity and continued growth. The number of people that are moving into that marketplace is tremendous, and the projections for what Middle Tennessee is going to do the next 10, 15 years is going to be huge growth. Yeah, around the state, Memphis, Knoxville, Chattanooga, Johnson City, we think we'll continue to see healthy growth in commercial activity, and particularly in commercial real estate growth. It doesn't feel like it's getting out of round at this point, and we're reasonably comfortable with what we see in a broad sense in the real estate markets.
Excellent. Now, let's talk about Texas and energy. You haven't done anything there yet, thank heavens. I mean, people were worried. We saw the distribution. You put out a very good pie chart showing you really have no exposure yet to speak of. When do you pounce? Do you wait till oil goes to 10? Do you wait for guys to go bust? Wait for loans to go bad and you scoop up some guy? What happens? You're the only guy with fresh capital down there.
Yeah, you're right. We don't have much in the energy space today. It's less than 1% of our loan portfolio, in the neighborhood of $200 million in aggregate energy exposure, and only about half of that is in Houston. We do think we've got a great team of bankers who are long-term, experienced in the Houston market, knows the customer profile, the customer base in the marketplace. And in some sense, as you described it, we're looking at this like 2009, 2010, when we had fairly low or modest exposure to commercial real estate. Great opportunity to pick up long-term relationships and do it with the strongest borrowers in the marketplace. So we'll pick our spots. We think we'll have some opportunities in 2016, and those opportunities will continue to grow in 2017. At some point, the oil markets will bottom out. I wouldn't be in the business of trying to pick when that'll be, but we'll be there. We'll be prepared to pick up those relationships when we have the opportunity to do it.
Well, I just one last question. I listen to political. It's tough to. I'm not a politician. Everybody wants to break up the banks or is bashing the banks. Is that good for a kind of super community bank like First Horizon? Are the big dogs kind of out of favor in your area?
Yeah, I think that is a very unhealthy dialogue, and I think we've painted with a very broad brush for the last 8 years when it comes to describing the financial services industry. Banks like First Tennessee, mid-sized banks that are in that less than $50 billion range, and I would argue even less than the $150 billion range, but certainly in our space, as you described, we're large community banking organizations. We live, we work, we participate on Main Street. We're involved in serving our customers in our communities, just like the smallest banks in the community, and at the same time the larger banks. We're not participating in the exotic products that got us into the trouble that we had in 2007, 2008. So I think it's an unhealthy dialogue. I think the sooner we can move beyond that, I think it's better for the economy and it's better for the industry, because the overregulation or the desire to overregulate will free up the ability to serve our customers and communities in a more flexible way.
Well, I couldn't agree more with you. The discourse has to change. Byron Jordan's the Chairman, President, and CEO of First Horizon National Corp. One cheap stock. Thank you so much, sir.
Thank you. Thanks for having me.
Bloom's too palpable in this group. These stocks are making money. It's time to turn on them. It's time to buy them. Stay with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.